In this video, I'm going to walk through a very similar example to your last comprehensive problem in Chapter 13. And we have Lou, who's a divisional manager, trying to decide between producing and selling product A or B for the next 5 years. His raises are based on the division's ROI, which has exceeded 23% in each of the last 3 years. And hopefully ROI sounds familiar from a past chapter. The company's discount rate, also known sometimes as the minimum required rate of return, is 15%. And he's calculated in our table here what he estimates that those expenses and revenues will be for those two different products over the next 5 years. So we want to do a comparison using the measures that we learned in this chapter. And before I jump into them, because we've got lots of numbers swimming around, I find that it's helpful to isolate the numbers that we need and do some initial calculations. One thing we need for several of these is investment required. And that's pretty easy to find. It's our second line here where for product A it's 290,000. That's the cost of the equipment for product A. For product B, the cost of the equipment is 490,000. The second thing that we'll need for some of these is annual net cash inflow. So that's going to include three different things: our sales revenues minus our variable expenses minus our fixed out-of-pocket operating expenses. These are things that are happening on an annual basis. Why do we exclude depreciation expense? Because it's a non-cash expense, not actually cash flowing out. So for example, for product A, it's sales revenue of 340,000 minus variable expenses of 154,000 minus fixed out of pocket of 79,000 equals $107,000. And I just added a line so I have that later on. You can pause the video and make sure you can come up to, for B, $175,000 to make sure you're on track. The next thing I need for at least one of the calculations is annual incremental net operating income. 2 is cash flow. 3 is accrual basis. What's the net operating income? Ultimately, we can look at this one of two ways. We can say, well, that's sales minus variable expenses minus depreciation expense, because I don't care if they're cash or non-cash, minus fixed operating expenses. The other thing that we could do is we could say, hey, I go back to 2, it's annual net cash inflow minus the one non-cash expense, which is depreciation expense. Either one's going to get you the same number. So for example, A, I could take my annual net cash inflows that I already calculated before, 107,000, subtract out depreciation expense of 58,000, and I get the annual incremental net operating income of 49,000. I can also take sales minus variable expenses minus depreciation expense minus fixed out-of-pocket expenses and get that same $49,000. Now again, pause the video, make sure for B that you can come up to $77,000. Now that's a lot of work just to get myself set up to execute my calculations a bit quicker. So the first one's going to be payback period. Payback period is telling me the relative amount of time it takes to recoup my investment dollars. So it's a period of time. What's the formula? Investment required over annual net cash inflow. So you can see now why I did this, to have this set up and have this information readily at hand. For example, we need our investment, we need our annual net cash inflows. For product A, it would be 290,000 investment divided by 107,000 annual net cash inflow. Payback period would be 2.71 years. So it takes about 2.71 years to recoup that 290,000 from the annual net cash inflows that are coming in over those 5 years. B, again, pause the video, make sure you can come up to 2.8 years. Who's better when I look at them relative to each other? If most companies want their money back faster, recoup their investment dollars faster, so it'd definitely be A. What's good about this measure? It's easy to calculate. It gives us an overall threshold. For example, we could compare this and say, when do we as a company have we set guidance for maybe we need to recoup our investment dollars within 2 years? Well, if we did that, neither of them would meet that threshold. What's a disadvantage, though, of this measure? It doesn't take in consideration the time value of money, so it treats future dollars like current dollars, which we'll learn when we get into some of our next calculations, which is comparing apples to oranges. So let's go ahead and move on to our next calculation, net present value. What do I need for this, at least initially? The initial investment versus the annual net cash inflows. So some of the same information that I need for the payback period. But how I'm going to handle is going to be different. So the purchase of the equipment is an outflow. That's what we're paying out for it, $290,000. The $107,000, keep in mind that's happening over each at the end of each of the next 5 years, 5 different times. But you could say, do I just take 107,000 times 5 and then subtract 290,000? Again, that would be treating future dollars just like current dollars. But keep in mind, these are happening sometime in the future. So what I need to do is use the present value factors to put the $107,000 in today's dollar terms, just like the outflow of the $290,000. How do I do that? I'm going to use one of the present value tables. Which one do I use? I use the annuity table, present value of annuity. And you'll see most of the factors on this table are greater than 1. Lots of numbers swimming around on this table. So how do I decide which one to use? The first thing is I want to use the row that corresponds to the period of time. Remember, this is 5 years, so I'll use row 5. What column do I use? I want to use the column that corresponds to the discount rate, and in this example, it's 15%. The column and row collide on the factor of 3.352. That's the present value factor that we want to use. How do I use that? I multiply that factor times the $107,000 to get $358,664. Again, I'm trying to take that $107,000 that's happening 5 times each in the next 5 years and put it in today's dollar terms. It's the same thing as saying that $107,000 at the end of the next 5 years is the same as having $358,664 today and being able to invest it at 15%. Why do I not need to discount the $290,000? Why does it list a discount factor of 1? Because it's already in today's dollar terms. Take the discounted inflow of $358,664 minus the investment today of $290,000. I get a net present value of A of $68,664. Pause the video, do the calculation for B. I'll come up to 96,600. Again, just make sure you can come up to that calculation. Who's better? B in this example. We want a higher dollar of net present value. So what's good about this measure compared to payback? I do discount the cash flows. I put everything in today's dollar terms, so I'm comparing apples to apples per se. So that's definitely an advantage. An assumption for this one also is that the inflows can easily be reinvested in a project at least equal or greater than the minimum required rate of return, which in this example is 15%. And for most companies, that's pretty realistic, this particular example. A disadvantage, though, is that if the investment isn't similar, if they're very different, here they are, $290,000 versus $490,000, it might not just be a fair comparison to say which one has a higher net present value. Yes, B gets 96,600, but it almost requires twice as much in terms of the initial investment. So later on we'll talk about PPI and how it has an advantage, that measure, compared to net present value. Before that, let's go on to the internal rate of return, which is also known as IRR. So internal rate of return has 2 different steps. The first step, we need to get a present value factor by taking the investment required by the annual net cash inflow. So you might initially say here, this is looking a lot like the payback period, which the numbers we get are the same ones that we got for the payback period. For example, product A, 290,000 divided by 107,000 is 2.71. B, 490,000 divided by 175,000 is 2.8. But we're not done here. This doesn't give us the internal rate of return. This gives us a discount factor. I need to use my present value table. I use the annuity table because, again, there's a stream of cash happening over the 5 years. What row do I use? Keep in mind, we're still talking about 5 years. Now I have to decide what column. The column gives me the actual internal rate of return. So I'm attacking this different than how I use this table for net present value. Keep in mind for A, we calculated a net present value factor of 2.71. So I have to look at row 5 and I just have to move over here and see what column gets me closest to 2.71, and that'll be my internal rate of return. There's nothing exactly, but 24% is 2.745 and 25% is 2.689. So I'll call a tiebreaker and say it's somewhere in the middle. Internal rate of return for A is 24.5%. B, the factor was 2.8. It's very, very close, just a little bit off of 2.803 on 23%. So we'll just go ahead and say it's about 23%. So again, I get my factor, go to my annuity table, and back into my internal rate of return. Internal rate of return is 24.5% for A. For B, it's 23%. Who's better? If I do a comparison, higher is better. So for this one, product A, 24.5%, it's saying relative that this is giving me a rate of return of 24.5%. What's good about this measure, very similar to net present value, it uses discounted cash flow, so that's definitely an advantage compared to undiscounted that Payback Period uses. What's a negative, and it's also easy to understand. Getting a percentage is easy to understand. It's relative with the investment that it considers. What's a disadvantage, though, is it assumes those annual net cash flows can be reinvested in a project or product similar to the internal rate of return. So A assumes I have something else that I can reinvest these dollars that come in at 24.5%. If I don't have anything close, that may be a bad assumption. What's the next one? Project Profitability Index, or PPI. What do I do with that? Net present value over investment required. So it has all the advantages of net present value, discounted cash flows, and it says, let me look at it relative to the investment required. So for A in part 2, we already calculated that the net present value is 68,664. The investment required here from a table above is 290,000. It gives me a PPI, or Project Profitability Index, of 0.24. Pause the video, make sure you can calculate B, it's 0.2. Who's better in this situation? It is going to be A. Higher is better here relative. So if I compare this again to net present value, it has the advantage of looking at relative to investment, so it's a plus. If I compare it to internal rate of return, it has the benefits of, assuming internal rate of return assumes you can reinvest those dollars at the internal rate of return, which may or may not be true. This one assumes that you can reinvest the dollars at least your minimum required rate of return or discount rate of 15%. So for a lot of companies, that's a good assumption. Our last measure here is simple rate of return. So I just abbreviated this here, SRR, annual incremental net operating income. I ran out of space. That's NOI, net operating income, divided by investment required. So finally, if you were wondering why I calculated annual incremental net operating income, it's for this one measure. I also have the investment. We've gone over and over again. So for example, for product A, annual incremental net operating income of 49,000 divided by the initial investment of 290,000 gives me a simple rate of return. This is a percentage. It would be 0.169, which we convert to a percentage, 16.9%. So again, nice advantage relative. I get an overall rate of return. What's a disadvantage though? Unfortunately, this one does not use cash flows, in particular discounted cash flows. So again, disadvantage, treats apples to oranges, future dollars like they're like current dollars, which isn't necessarily true. But again, very easy to understand a rate of return. Who's better if I compare A to B? Well, bigger is better. Bigger rate of return is better, 16.9%. Now I'm going to go slightly out of order and go ahead and go to 6B, which says based on the simple rate of return, Lou would likely. Well, let's go back here. Lou's raises are based upon Lou's ROI, which currently his rate of return is 23%. Unfortunately, because both products are returning less than the 23%, he would probably say, sorry, I don't want to do this because I would lower my ROI and my overall raises would end up being lowered. On the other hand, if you remember from the chapter on ROI, the company would still want him to do it because their minimum threshold of 15% and both of these products meet this particular threshold. Last, so he would say thumbs down even though the company would want him to do it. Last thing is just measure by measure. Let's do our final comparison. Well, several of these measures end up saying product A is the one to go with. Net present value is the only one that went with product B. So when we have measures that give us these different results, which one ultimately am I going to probably go with? I'm going to probably opt for that project profitability index. Again, uses discounted cash flows, also looks at it relative to the investment, which the investments are very, very, very different. So in this example, I would more than likely go with A.